For years, people said one thing about Rolex: it only goes up. That belief felt untouchable. If you bought the right model, especially a steel sports piece, you weren't just buying a watch, you were buying an appreciating asset. But since early 2022, that narrative has been dismantled, not by a small pullback, not by a brief dip, but by a sustained multi-year decline that erased massive paper gains across the market. This wasn't a 5% adjustment. It wasn't even 10. In many cases, prices have fallen 30 to 40% from their peak levels. And despite a small stabilization recently, the data suggests the market may not have fully reset yet. To understand what happened, you have to rewind to before the chaos. In 2019, the Rolex market was strong but relatively stable. Demand exceeded supply, but prices weren't irrational. Then 2020 arrived. Global disruptions reduced Swiss watch exports sharply. Production slowed. Supply tightened dramatically. At the same time, liquidity in the financial system increased. Stimulus money entered the economy, and speculative behavior intensified across multiple asset classes. Luxury watches became part of that speculative wave. Social media amplified the effect. A stainless steel sports watch turned into a symbol of financial success. Owning certain models wasn't just about horology. It became a statement about winning in markets. Scarcity, both real and perceived, drove urgency. Authorized dealer waiting lists added to the mystique. And suddenly, the secondary market exploded. By 2021, prices were accelerating rapidly. Models that had always been desirable became commodities. Flipping replaced collecting. The narrative shifted from craftsmanship to profit margins. Watches were no longer discussed as heirlooms, they were discussed like stocks. Then came early 2022, the peak. Resale averages reached record highs. Some pieces traded at double their retail price. Confidence was extreme. Many believed there was no ceiling. But bubbles don't deflate politely. As interest rates began rising and speculative assets across the board started falling, from cryptocurrencies to growth stocks, liquidity tightened. The easy money environment disappeared. The same individuals who had entered the watch market for quick profits began exiting just as quickly. Inventory surged. Secondary dealers found themselves holding large quantities of stock purchased at peak levels. Flippers rushed to offload pieces before prices slid further. And once momentum reversed, psychology shifted fast. Throughout late 2022 and into 2023, the correction accelerated. Average resale values dropped meaningfully. What initially looked like a temporary cooldown revealed itself as a broader unwinding. The speculative premium that had inflated prices began dissolving. By 2024, the market reached multi-year lows. Indexes tracking leading luxury watch brands reflected continued softness. The decline wasn't dramatic month to month anymore, but it was persistent. Instead of crashing vertically, prices drifted downward in stages. Now, in 2025, there are signs of stabilization. The rate of decline has slowed. Certain segments have flattened. A slight uptick in some areas has appeared. But stabilization is not the same as recovery. Markets often pause before finding a true equilibrium. Currently, average resale prices remain well above pre-2020 levels, but significantly below peak mania highs. The most hyped steel sports models have seen the largest corrections, often approaching 40% from their top. More conservative models have declined too, though less dramatically. So why has this correction been so deep? And why might it not be fully over? First, oversupply. During the boom, many buyers accumulated inventory expecting perpetual appreciation. Once price momentum reversed, that inventory flowed back into the market. When supply expands faster than organic collector demand, prices adjust downward. That rebalancing process can take years. Second, macroeconomic pressure. High interest rates reduce disposable income and dampen speculative enthusiasm. Luxury goods, especially five-figure watches, become discretionary expenses rather than impulse investments. When capital has alternatives offering guaranteed yields, speculative watch buying becomes less attractive. Third, cultural shifts. The hyper-visible flex era appears to be cooling. A growing segment of younger luxury buyers lean toward subtle or independent brands rather than universally recognized status symbols. While Rolex remains powerful, the social media-driven hype cycle has softened. Fourth, retail price increases. Rolex continues to adjust retail pricing upward, particularly on precious metal pieces. But when secondary values decline while retail rises, it creates psychological friction. Buyers begin questioning the premium. Confidence weakens when resale narratives break down. Finally, the departure of speculators. The surge between 2020 and 2022 was heavily influenced by short-term opportunists. That capital has largely exited. What remains is closer to traditional collector demand. Steady, but not explosive. Not all segments have performed equally. Steel sports watches that were central to the hype cycle experienced the steepest pullbacks. Meanwhile, genuinely rare vintage references and historically significant pieces have shown more resilience. These were not inflated by speculation to the same degree, so their corrections have been milder. Here's the reality many avoided acknowledging. Perceived scarcity is powerful, but it is also fragile. Once confidence shifts and supply surfaces, premiums compress. That doesn't mean the brand itself is in trouble. Rolex remains globally dominant with unmatched recognition. But the idea that any Rolex purchase is a guaranteed profit vehicle has been challenged in a very public way. We are now in a rebuilding phase. The market is trying to rediscover a price level supported by actual collectors rather than momentum traders. That process takes time. To summarize, prices have fallen significantly from 2022 highs. The correction has lasted multiple years. Recent stabilization does not equal recovery, and unresolved forces, supply levels, economic pressure, and sentiment still influence the trajectory. So the real question now is strategic. If you were entering the market today, would you see current prices as opportunity? Or would you wait for a deeper reset? Do you believe stabilization marks the beginning of recovery or simply a pause before further adjustment? Let me know your perspective.